Welcome back to World Crisis Radio. Webster Tarpley here in Washington, D.C. The FinReg bill, the so-called Wall Street reform, a monstrosity, a hollow shell, a gutted wreckage, a derelict. And you're going to have to wait 12 years to get any regulation of derivatives by commercial banks at all. With Franklin D. Roosevelt, we had the 100 days. With Obama, we have the 12 years as the Depression deepens in the second wave. So remember, what was needed was Glass-Steagall from 1933 to 1999, and from Franklin D. Roosevelt all the way down to the lunatic Graham-Leach-Bliley bill of 1999, we had the barrier between stock jobbing, investment houses, brokerage on the one hand, commercial bank with FDIC deposits on the other, separate, rigorously firewalled. And that had begun to erode, and along comes Phil Graham with his big mouth, and Leach, whose name is his program. He's part of the Wall Street Leach faction, and Bliley, forgotten now, but they tore down the firewall. Now, the need was to recreate the firewall. The way that would have been done was the Cantwell-McCain amendment, which was voted down. So Glass-Steagall was removed from the process very early on. Then we had the weak, inadequate substitute of the so-called Volcker rule, saying that commercial banks cannot trade in derivatives and other speculative investments for their own account, proprietary trading. Problem is, where is the line between market making on the one hand, proprietary trading on the other? Count on the Wall Street jackals to blur that line and to poach across it. And, of course, along comes Scott Brown driving his truck, his populist prop, enough to dupe the Massachusetts Tea Party. But, of course, he serves Bank of New York Mellon, State Street Bank, and other financial interests there. Fidelity Investments in Boston, right? Big headquarters of mutual funds and all that. So what he does is he says you can now put aside 3% of your Tier 1 capital, 3% of your basic capital, put that in a hedge fund and buy derivatives. And that, since it's only 3%, well, if you were just buying stocks, right, if it's 3%, you put 3% in stocks, you lose 3%, that's the end of it. But derivatives, of course, derivatives with their wonderful creativity allow you the possibility to lose 50 to 1, 100 to 1, 300 to 1. There's no limit because you've got options in there, you've got leverage, you've got structured notes, and so forth, right? You start with mortgage-backed or asset-backed securities, credit card debt, any other kind of debt. Make that an asset-backed security. You put that into a collateralized debt obligation. You take a bunch of collateralized debt obligations, you put them into another collateralized debt obligation. That makes a super CDO or CDO squared. You sprinkle that with some credit default swaps, you put that inside a structured investment vehicle, and you have got a mass of kited derivatives which can have hundreds and hundreds of levels built in. And with that, you can lose 50 to 1, 100 to 1. It's easy. Bear Stearns showed the way in the spring of 2008 when Bear Stearns blew on the Ides of March 2008. They were making, I think their losses were 50 to 1 on two hedge funds, and you can get up to 100 to 1. So even if you lose 50 to 1, and Bear Stearns shows you can do it, you lose 50 to 1. If you put 3% in there, that's 150%. You are wiped out. You are gone. So that's going to be the limit. No limit at all in the world of derivatives, but there's more. The latest edition was made not in the C-SPAN televised hearings, but in the dead of night when this thing was revisited, because the zombie banks kept saying, no, it's still too much for us. We need more time. We need time to unwind. As soon as you hear unwind, it means derivatives, just as a parenthetically. When they say exotic, it means derivatives. Complex means derivatives. Unwind means derivatives. Toxic, of course, means derivatives, but unwind. So we need more time to unwind. So how much time do you need? 1 year, 2 years, 3 years? No, 12 years, 2022. You can wait until 2022 for even this wretched thing to go into force. And here's what it is. Comes from various press organs, right? It's all documented. Tarpley.net, and it cites the relevant things. You don't have to plow through the whole articles. I've excerpted them for you from Business Week, Bloomberg, and the London Guardian. Language in the Act, we read in the London Guardian. Language in the Act allows for a 6-month period of study, followed by 9 months to write the rules. Then there's a grace period and comment period of 12 months. So we're already up to a year, 2 years and a quarter. Once the final rule is set up, the banks have 2 years more to conform. And if that's not enough, they get a 3-year extension. And if you add this all up, you get 12 years. Take a look. It's up at Tarpley.net. So essentially, we got plenty of time for more financial catastrophes. So this thing is a monstrosity. There is a fight in the Obama regime. The good government types, right? The petty bourgeois good government activists want to bring in Elizabeth Warren, the very prim law professor from the Harvard Law School. It looks like the Harvard Law School is getting too much power between Kagan at the Supreme Court and this Elizabeth Warren. But Tiny Tim TurboTax Geithner, the tax cheat, says no, he doesn't want Elizabeth Warren. She's a loose cannon. She might not respect Wall Street interests enough. So a good fight between the petty bourgeois good government types and the gangsters from Wall Street, featuring Tiny Tim Geithner. So I hope that, again, the more the merrier when it comes to these things that stop these people from doing what they want to do. The bill does nothing. It does not ban credit default swaps, which destroyed AIG. It does not ban collateralized debt obligations, which destroyed Bear Stearns, Lehman Brothers, Citibank, Merrill Lynch. It does not impose the 1% Tobin tax on Wall Street speculation. It does not return us to Glass-Steagall. It does not ban adjustable rate mortgages that have destroyed millions of American families. It does not cap interest rates or ban payday loans. It does not stop foreclosures. The most important, the most fundamental thing, stop foreclosures for 5 years or the duration of the crisis. It does set up some bureaucracy. It's got 250 to 500 regulations, we're told, but nothing serious, just enough to be burdensome without helping the people that are supposedly being helped, but are being betrayed by Obama once again. Back in a minute on World Crisis Radio.